Hi folks, and welcome back to Meaningful Money. Today we're going to be looking at some classic investor mistakes and how to avoid them. Okay, I've got 9 of these mistakes, but I'm going to break it up because 9's a lot for one video, and instead I'm going to deal with 3 in each of 3 videos. Sound okay? The first classic investor mistake is trying to time the market. Timing the market. It's totally impossible. This manifests in 2 ways. Firstly, bailing out of the market at the wrong time. Markets are sliding. People think, I might as well get my money out because I don't want it to get any worse, and that's the worst possible time to come out of the market. But let's say you do that, you've made mistake number 1, but then you've got to decide when to get back into the market, and that's the sort of second manifestation of this mistake. Firstly, bailing out at the wrong time, and secondly, not knowing when to go back in. So how on earth do you avoid making the mistake of trying to time the market? Well, firstly, it's about investment strategy. If you're spreading your money widely across all kinds of different asset classes, then it should largely look after itself. That's a recurring theme. Listen out for that as we go through these 9 mistakes. Invest well in the first place, hang in there for the long term, and you can forget about trying to time the market. You'll get it wrong anyway, so why bother? Now, if you are coming to a point where you're going to need to access some money, you might want to consider reducing the risk of your investments. We call that lifestyling, but do it intentionally, not automatically, as you can often get with some pension plans and other kinds of things. So invest well, hang in there for the long term, think about reducing risk as you approach the time when you might need some money, but otherwise, just let it run. The second classic investor mistake that I see all the time is insufficient diversification. That's a whole load of syllables, which simply means not spreading the money around widely enough. Now, this comes in 2 main forms. Firstly, investing too much in the UK. Now, if you're watching this in the UK, you are a UK-based investor, so it's maybe logical to put the bulk of your money in UK assets. But the UK is only 8% of world stock markets by value. So there's a whole world of value out there that you're not taking sufficient advantage of. The second way this manifests is over-venerating a particular fund manager or fund house. Yes, I'm looking at you, Neil Woodford fans. He's a superb investor, but he's not God. So over-venerating and putting too much money with one fund manager is always a dangerous idea. So how do you avoid making this mistake? How do you avoid insufficient diversification? You simply have more baskets in which to put your eggs. So you have different kinds of asset classes: shares, bonds, property, gilts, cash, commodities, infrastructure, timber, all kinds of things. Spread the money around, not just in different asset classes, but also different geographical locations. As we said, spread the money around the world. Asset classes and geography, having more assets, reduces the chances of you being too focused in one area. And the third mistake is switching funds too often. We've maybe all done this. You choose a bunch of funds that you're happy with, you check how they're doing, you're pleased, you made some good choices, and then one of your top funds begins to slide. It becomes not a top fund anymore. It becomes mid-table. Even worse, it becomes a really bad fund relative to its peers. So what do? The temptation is to keep switching funds, choosing the best manager each time, always chasing what you think is the best fund. But by switching too often, you're not giving the managers of your funds time to do their job. I would widen the window that you're looking at so that rather than switching all the time, you maybe take a high-level view of your portfolio once a year, something like that. Of course, the best way to avoid switching funds too often is to stick to passive investments, and then you haven't got to worry about it at all. So that's the first 3 of 9 classic investing mistakes: trying to time the market, not spreading the money around widely enough, or switching funds too often. There's 3 more to come next week. Thanks for watching.